Hi, my name's Will Rhode. I'm Director of Fixed Income Research at TABB Group, and I'm joined by Steve Shaw, Managing Director at BondDesk today.
Well, good to see you.
Good to see you too, Steve. We just published a piece about the value of retail liquidity for the corporate bond market on TABB Forum, and I thought it was really interesting. You guys gave me an opportunity to look at your data, and I was really intrigued by, well, surprised actually, by some of the numbers that you showed me. Do you want to talk a little bit about why you feel that this is a new time for retail liquidity in corporate bonds and the value add that platforms like BondDesk can bring to the table?
Absolutely, and Will, thanks for having me.
Pleasure.
So, I think the important thing to realize in what's been happening in the marketplace is that even as liquidity from primary dealers has dropped over the last several years, liquidity on BondDesk has actually increased significantly. We've increased liquidity about 4 times over the last several years. And what that's resulted in is a very competitive marketplace. So you can go in and look at a highly liquid investment grade CUSIP on BondDesk, and there could be 15 to 20 dealers who are making a market in that same CUSIP. And so one of the things that we found is that if you're trading in $1 million and under, and you would have had the option to trade on BondDesk for those trades, you could have improved your execution in those trades a third of the time for a third of those trades. So we think that more and more with improved liquidity on our system, trade size falling down, dealer liquidity reducing, there's a great void for BondDesk to fill in those trades.
Yeah, it's interesting for us as well because we typically focus on the institutional space, but one of the big stories has been around falling ticket sizes. And there's also been a lot of talk around odd lot markets and what is the size of an odd lot market, and then we can take a view about what would constitute a retail sized trade. Do you want to talk a little bit about how you see the kind of the ticket landscape changing and how you would define it today?
So the way that I would define it is I would refer to retail as anything less than 100. So if you look at BondDesk traditional marketplace, that's usually where a lot of our trades take place. So about 90% of our trades take place in under 100. The next market is really what I would refer to as the odd lot market from 100,000 up to $1 million. And that's a marketplace where we have significant liquidity. In our corporate bond platform alone, we have about 15 billion of liquidity. We have 15,000 unique CUSIPs for all those different trades. So that's how I would define it in our marketplace.
And what about the ability for a whole variety of players to access these markets in a fair way? The SEC had a roundtable a week or two ago talking about the ability for investors to get access to the corporate bond market. Of course, we know that the big players dominate the primary allocations for a lot of institutional investing. What do you see in terms of what the SEC was talking about and the ability to access liquidity in fair markets for a whole range of types of investors?
So what we've seen is on the institutional side, we've seen a lot of OMSs and EMSs trying to find ways to provide a full view into the marketplace. So right now someone might just be looking at one platform, but what they're looking to do is to not only have those different platforms that exist today, that they're seeing today, but to also stream in live liquidity from platforms such as BondDesk. So we see that as a big trend happening in the marketplace, and we think that from a regulator's perspective, that's great news for them because it's going to ensure best decks for not only institutional investors, but when retail investors are looking at these markets as well, they can already access those markets on BondDesk and see the high quality pricing on our system.
So one of the other things that came out of the SEC roundtable were how the retail investor can be fairly treated in this marketplace. You guys have got some tools that basically show investors how they're getting best execution, and tell us a little bit about what your offering is.
So first we show the full depth of book that's available to the investor. So when someone comes in and is buying an investment grade bond, they'll be able to see where there are 4 dealers offering this, or where there are 15, or was there 1. So immediately they're able to see, is this a competitively priced offering? They're also able to go and compare it to the most recent trace prints. They're able to see the comparable yield of the bond that they're looking to buy compared to similar securities. So when people are looking to buy bonds, we have a bunch of tools that help them. We also have a suite of suitability products so that right away, if you are a conservative investor focused on principal preservation, the system's not going to let you buy a C-rated high-yield bond. We also alert investors, so if there are material events that happen, if there's a significant price change, all different sorts of things, a ratings change, different things that could happen in the life of that bond, we alert them immediately so that they can be proactive and address their investors' needs in case they need to move in or out of a security.
Now, electronic trading in fixed income is not a new development. It's been around for a while, and you guys have been around for a while. Why is this different? Is this all about the dealer inventory model and all the challenges in that space and what people are thinking about in terms of quantitative easing and some of the challenges to the buy side? Why is this fixed income electronic story different today than it was, say, in the 90s or in the noughties?
Yeah, so I think if you go back at that time, you had market share, which was defined by the big dealers. So the top 10 dealers would account for a very significant part of the market share. What we've seen in our marketplace, going from 2008 to today, the market share in corporate bonds is very dispersed from the larger dealers to the smaller dealers. And we think that the power of the regional dealers, the power of the mid-sized dealers has increased significantly because they come in, they put up very high quality markets on our system, and a wide variety of different firms can access that liquidity. So that's why I think it's different than it was 10 or 15 years ago, where those firms weren't really in the space.
And you've had some interesting, doing some interesting work with NASDAQ, I believe, because some of the concerns, as we've talked about, is this issue of if interest rate volatility returns, then the buy side will have a challenge in terms of managing their portfolio risk. And the way we've been thinking about it in terms of, well, they have to access new sources of liquidity to mitigate that challenge. But you've been doing some work with NASDAQ over the Treasury option space, right?
Right. So NASDAQ a couple months ago launched a new Treasury options product, and we are the underlying benchmark for that product. So what they do is we send in our live Treasury data to them, and that's what opens up the options market, helps them calculate settlement values, and also helps them surveil the market to make sure everything's trading well. The interesting thing about this product is that if you hold treasuries, and this is for the 10 and the 30 year on the run, and if you're concerned about rates going up, you can buy puts and protect your principal. If you're concerned that rates are too low and they're never going to go up, you're able to write options contracts and significantly increase your return on your holdings. So we think it's a couple of things. First, it's a great tool for investors to use to hedge their risk, and secondly, it validates the quality of the BondDesk pricing in the marketplace.
Yeah, that sounds good. It's encouraging to see actually that there are solutions coming to market, and there are people thinking about way to actually address some of these challenges which have been worrying us for quite a while. So, I mean, I think that's a good point at which to wrap it up. But thanks very much for joining us today, Steve. Thanks, folks.